I think we can go ahead and get started, and a few more people might join in the next couple of minutes here. All right, so welcome everyone to our third installment of the BWC Dialogue series. This series gives members a chance to engage in conversation on emerging real-time events and issues. Because of this, we really appreciate hearing new topic ideas from you all. So please do not hesitate to reach out to myself or to Elena, and we would love to collaborate with you on a new episode. Today's conversation will center around US dollar competitiveness and will feature William Dudley, BWC Chair and former New York Fed President, and Dante Disparte, Chief Strategy Officer and Head of Global Policy for Circle. I'll hand it over to Bill in just one moment, but first, a little bit of housekeeping. This conversation will be in two segments. The first will be the conversation between Bill and Dante, and the second will be a Q&A session. And for the Q&A, I will ask that you write your questions in the Q&A box, and then I will give you the floor and unmute you so you can ask the question. I think that's everything for me, so thank you very much. And Bill, over to you.
Thank you so much, Zach. It's great pleasure to be here with Dante today to talk about the US dollar. It's been dominant for probably more than almost a century, really starting with the Great Depression onward. US dollar is dominant in trade, it's dominant in capital markets, it's dominant in central bank foreign exchange reserves. About 60% or so of foreign exchange reserves around the world held by central banks are in dollars. When people talk about liquidity support in global markets, they look to the Fed and the foreign exchange swap network that the Fed has put in place. Lots of benefits of the dollar being so popular. Signorage, about 2/3 of all US currency outstanding is held abroad. So that's essentially an interest-free loan that the US is getting on that currency outstanding. Also, the fact that the US capital markets get supported by the dollar as a reserve currency, I think leads to lower cost financing for the United States. And it really allows the US to live a little bit beyond its means. Over the last 34 years, the US has run persistent current account deficits, which means basically that the US is actually spending more than they're actually generating in terms of output here in the United States. But this doesn't necessarily mean that just because we've had a really good thing going here in the United States, that it'll necessarily go on forever. A couple of things I think that are worth noting. One is the emergence of China. The Chinese economy is not much different in size now than the US economy. The use of sanctions, and I'm sure Dante will get into this in a minute, is also very important because it basically reduces the appetite for some countries to use the dollar because they don't want to be exposed to sanctions. And I think the last thing is the commitment of the US to global leadership is important. And that depends on the politics in the United States. And I think at the margin, the US has been sort of disengaging globally rather than engaging globally. And so if the US steps back, that will also have implications for the dollar going forward. So Dante and I are going to discuss these issues in some detail. And I want to start asking Dante a very simple question. How would you assess the current competitiveness of the US dollar, and how do you think that compares to where we were, say, a decade ago?
Yeah, well, first of all, Bill, it is great to be on a virtual conversation with you, and it seems somewhat historically fitting to have this conversation, alongside members of the Bretton Woods Committee. So, the assessment is, if we were doing a State of the Union conversation and we were talking about the dollar being the union, I would say the State of the Union is still strong. However, there are some alarming, emerging trends that I think really deeply matter. And you described in your opening commentary some of the historical benefits that put the United States and put the US dollar in a position of great privilege. However, those endowments that we have aren't assured in the very long run if, for example, we don't really contemplate as a country the utility value of the dollar, right? So in the world that I live in, and in a company like Circle, where we're really focusing on what does the dollar look like in a global internet economy, an economy that doesn't take bank holidays, an economy that isn't enshrined in brick and mortar, and where candidly, the utility value of dollars, if they only remained in physical form, would be as far as my arms could reach. And so in that world, this idea of having payment systems optionality, this idea of really innovating on the edges of transmissibility of the dollar is a space in which I think there's some hard choices for us to make in the United States. And candidly, you could also see around the world part of this question of dollar decoupling or de-dollarization. Again, I don't think the trend is as alarming as many headlines make it sound, but it is a very real one, and it's not likely going to be measured in years or quarters, but rather in decades. And in decade spans, we have many, many gaps in the US payment system, which I'm hoping to discuss in more detail here with you. And that's the piece that matters. The dollar is merely the payload. The rails on which the dollar rides is the breakthrough when you think about innovation in the movement of money and not just the reserve currency status vis-a-vis central banks.
So if you were to rank the sort of strengths, things that support the use of the dollar and the things that are maybe weaknesses in terms of the use of the dollar, what would you put as the positives and what would you put as the negatives?
Sure. I mean, well, for one, I think the positives, and I think it's a good way to frame it in terms of risks and rewards, right? I think the positives are well known. The transmissibility, I always try to describe that if you want to understand the future of money and payments, past is prologue, right? And so, for example, the advent of checks and the checkbook wasn't a breakthrough innovation that dethroned the dollar. Rather, it was a breakthrough that paid homage to the dollar and allowed the end user of checks to set a denomination and a use-by date. But nonetheless, the check was a powerful breakthrough. And across the spectrum of movement of money innovations, you see a whole host of these use cases and extensibility that end up, having this public-private partnership model to them. All of those are part of the supply chain globally that make the dollar, perhaps rivaled only by Coca-Cola, the most widely exported, widely understood medium of exchange all over the planet. Today, fast forward to where we are right now, if you think about it, many describe this sort of era of digital currency, for example, as a space race, right? That 114 central banks, according to the Atlantic Council, 95% of global GDP, are weighing this question of, do they issue a public digital thrift or do they enable private sector activity on the movement of money as a native currency on the internet? I think that's a domain in which dollar competitiveness has choices to make. Even there, I still think the dollar is the principal currency of reference. But as you know very well, we're still far from legitimizing this innovation, and then far from the ability to disambiguate internet funny money from genuine digital dollars. And so that's the space where I think most of the future of this conversation will be held and defined by what happens with the digital currency space race.
Look at stable coins. Most of them are almost all of them, I guess, are pretty much pegged to the dollar, right? I mean, there's not much activity in stable coins that are not dollar reference, correct?
However,
is that changing?
Well, the question is, the however is sort of the basic Jerry Maguire test, show me the money. As you know very well, and as I'm sure Bretton Woods committee members will appreciate, trust but verify is not an activity that should be held to the standard of people's promissory statements on Twitter. And so we learned the hard way last year, a bit of an analogy to the crypto Dodd-Frank moment, if you will, where the industry lost $2 trillion last year. The match that set that cascade or that daisy chain of losses on fire was an algorithmic stablecoin known as Terra Luna that was, again, trying to establish this operating model of price parity to the dollar and a peg. That broke, and with it, of course, along came $2 trillion of cumulative losses that year. And so while today the principal stablecoins in circulation are dollar reference, not all of them are created equal. And candidly, none of them yet enjoy this idea of whole of government regulatory clarity and legal clarity, which makes it an export product around the world. So that's an interesting area of opportunity as I would see it.
No, I mean, U.S. regulators could make the stable coins a lot sounder. For example, you had a stable coin backed by Federal Reserve balances. People would view them as much more trustworthy than what we've had up to now. So I want to turn and ask you, so we're obviously, dollar is ascendant, but at the margin, you probably say that it's probably becoming a little bit less ascendant over time. What do you think the main factors are driving de-dollarization? I mean, how much do you think of it as the emergence of China as a competing global economy? How much of it is the US sanctions? How much is the fact that the US has been not very forward-leaning in terms of coming up with ground rules for how cryptocurrencies and stablecoins should operate? Where would you sort of assess the factors that are most important in driving this.
Yeah, well, let's start with the own goals first, right? So if you think
Okay.
about, it's easier to look in the mirror when you're actually going to describe your own goals instead of describing a world in which there's a U.S. versus China tension, which I think is real. But the own goals in my mind matter more because those are the things that we could remedy societally. For example, the United States today, payment systems innovations are regulated at the state level. Yet, if you think of us compared to most advanced economies around the world, we're the outlier in not having a whole of country or national payment systems charter overseen by the federal government or prudential and banking regulators. That's an own goal. For example, the ill-fated Facebook Libra project set itself up in Switzerland, not because of regulatory arbitrage, but because the Swiss regulator FINMA has a financial markets infrastructure license that could contend with bank-like risks and payment systems risks side by side. Nearly 5 years since, and many congressional hearings and Senate hearings since, we have failed to understand that as a mere level playing field. The United States is rolling out something close to home for you, given your Fed background, FedNow, facing fierce opposition, a degree of conspiracy in its reception, but FedNow would merely be a domestic payment systems improvement that levels the playing field to other major economies. But yet the reception is partly conspiratorial. Is FedNow a backdoor CBDC? Some would argue. Is FedNow going to blunt the efficacy of private sector payment systems such as the clearinghouse and so on? And so just from a domestic payments vantage point, we're woefully behind. And then the pandemic shows up. And as a country, we have to mobilize, nearly $7 trillion of taxpayer-supported public relief. And what rails did we use? And how quickly could we move money at population scale? And those were domestic payments vulnerabilities that no adversarial country or company or other actors visited upon the United States. That's an own goal. And so I think improving against those own goals, plus encouraging and destigmatizing the use of novel technologies in banking and payments, would encourage more competition and more optionality. When you look at that and you cast the scope around the world, then I do think the trend line is, de-dollarization is a real phenomenon, but it's also a phenomenon partly driven by the weaponization of the dollar, which is fundamentally the weaponization of the underlying rails, be it SWIFT or other networks. So I think that's the trend we have to contend with globally. But the own goals, I think, are the easier thing for us to remedy if we get it right.
I think you alluded to the fact that sanctions do reduce the potential appetite for dollar usage by countries who may fear that in some future state of the world, they might get sanctioned. I mean, I think it really depends on what country you are. I mean, I don't imagine Canada expects to be sanctioned by the United States anytime soon, or Australia, US allies. But you can certainly imagine a lot of countries that are, neutral, not aligned, could run afoul of US sanctions down the road. And, we talked about before we went on air, if any dollar transaction anywhere in the world can be subject to sanctions, because those dollar transactions ultimately have to settle back into the US at the Federal Reserve. And
Correct.
So the reach of the US government is long when you use dollars. And so, the use of sanctions, in my mind, is a really important factor. Maybe, encouraging countries like China, for example, to develop an alternative payment system where they won't be potentially subject to sanctions. We also see it in foreign exchange reserve holdings. China has diversified their foreign exchange reserve holdings significantly over the last year or two, and in fact, they're buying a lot of gold now. Why? Because they don't want to run into problems with the U.S. Maybe perhaps around some flashpoint issue like Taiwan, where the U.S. would put sanctions in place, and that would impede the China's ability to use their foreign exchange reserves. So how important do you think sanctions are in all of this?
Well, look, first of all, I think sanctions are a very, very big driver, but it's also the question of which counterparties and which value systems would be enshrined in the rules-based financial system when it comes to money movement, right? So the presumption is a single dollar is misused anywhere to the extent the counterparty that has moved the dollar is responsive to the Office of Foreign Assets Control, filing, suspicious activity reports with FinCEN and so on. all of that depends on the degrees to which the payment networks and the money movement networks and banks and others are responsive to a rules-based regime. What we saw, however, to your point, there's a long arm of US accountability when dollars are used anywhere, but there's also a long memory in terms of how dollar weaponization, and again, the dollar is merely the payload, the weaponization happens at the payment rails level. And so calling SWIFT to be able to micro-target specific banks, for example, in the war of aggression that Russia has caused in Europe against Ukraine, the ability to micro-target a specific actor, a specific bank, or a country is the degree to which the payment networks are responsive to a set of rules. And so much of the world's alternative payment systems innovations, again, a space in which I think the United States is lagging, are in no small measure to build alternative payment networks that are non-responsive or censorship resistant. And therein lies, candidly, if we're in this digital currency space race on the one hand, I would also say the other analogy that's worth thinking about is this equivalent of a digital assets 5G wars. In the same way that there are companies and countries whose telecommunications infrastructure, software and hardware providers, you wouldn't want building infrastructure because of privacy concerns or spying concerns or other concerns. The hardware and software that is moving money today, increasingly at very, very high levels and increasingly sort of as an export product, are also designed effectively to be resistant to things like sanctions. They're designed to be resistant to a whole host of impositions, so-called American soft power and Western soft power. That's the piece that we have to be concerned with, right? And again, I just think the return of conflict in Europe, this nation state vector in the movement of money around the world, does create this risk of polarization or bifurcation of the planet and how money moves around the planet. And, you know, just like 5G, we might live in a world with two 5G networks, so to speak. Does this also represent a risk in terms of how money moves?
Well, obviously, if we could go that route, we're introducing a lot of friction. It's sort of like the supply chain redundancy that's going on today. Obviously, that's probably a good thing from a ability to continue to operate, but obviously it increases complexity and increases costs. So there's a price for that insurance. How do you assess that? So when people talk about alternatives to the US, I think there's probably two currencies that come immediately to mind: the euro and the Chinese yuan. How would you assess where they are? What are their strengths and weaknesses, and how far are they away from being truly competitive with the US?
Well, it's sort of in their domestic payments environment. I think it's arguably within any country or any central bank or any monetary union's sort of prerogative and interest to develop a currency zone and a payment environment that suits their domestic markets and business and economic activity in the domestic markets. In fact, you could argue that a lot of what has transpired in China, particularly the digital currency initiatives, are responsive to two phenomena that don't get too much discussion. One of them was the rise and dominance of, effectively financial services super apps like WeChat and Alipay and so on. Plus, there's a high degree of unbanked populations. And so you could argue that, addressing the domestic void and the domestic concentration of risk in certain actors, was this a soft expropriation of some of those assets by the PBOC in order to enable a domestic payments environment that's a little faster and so on and more responsive to financial access in the country? But even there were still concerns of among commercial banks about deposit risks and flight of deposits to the alternative, to the ECNY. The question is, can it become an export product? And for something that was just put online at the Beijing Winter Olympics to go from 0 to more than 300 million sort of ECNY enabled digital wallets around the world, that's the piece that's novel, right? Is if you think of payment networks and mobile money networks like M-Pesa, but you now have the prospect of leveling them up to population scale and world scale, do you send a cross-border payment in that world? Or are you merely, like with the internet itself, transacting amongst known and trusted counterparties? And so that's the piece where a lot of the rules that we understand and expect of territorial integrity with money, cross-border payments with money flows no longer get respected when money itself becomes digital and the rails become device-centric and basic internet-connected device enabled. Those two phenomena are happening in really, really big ways. and are hard to quantify right now. And so those are the things I think we should be concerned with. In the Eurozone, obviously, like China and like other major economies and regions, the Eurozone equally wants to have a protectionist strategy. I think broadly a desire to protect the Eurozone from sort of encroachment of dollars and so on. And so my analogy, for example, is the French can create a new word for the word email, courriel in French, instead of transliterating from English. But imagine if the French had tried to create an alternative internet altogether that was disconnected from the global one. They would miss out on the real network effects. And so that piece remains the more interesting one. Again, when it comes to this global network of internet native money, that's really important.
I see China as being potentially very competitive, especially on the use of Chinese yuan for trade. But I think that both Europe and China are far behind in terms of the use of their currency as a foundation for the capital markets. The problem in China, I think, is really threefold. Number one, there's questions about the rule of law. Number two, the currency isn't necessarily always going to be convertible. You can't always necessarily get your money out of China. And three, you don't have deep and liquid capital markets. For Europe, you have the rule of law and you have convertibility. But again, you don't have deep and liquid capital markets. I mean, Europe is still pretty fragmented. And so you don't have anything like the depth of capital markets that you have in the US. So I feel like the dollar's role is changing sort of on two tracks. The trade track is probably going to go pretty fast, but the capital markets track, I think, is going to be very, very slow. What's your observation?
Yeah, well, first of all, I think you're completely right. The two tracks matter, and in both, you could argue there are efforts at decoupling from the dollar. So, I don't think de-dollarization is a destination; it's a journey for countries. And the fact that many countries, I think now for nearly 80 years, have sort of been at the mercy, both the good and the bad things that come with dollar dependency and a reserve status of a currency. But for 80 years, many, many regions, Europe, Asia, and many other countries around the world have, through thick and thin, ridden on the fortunes of the dollar. And here's the issue that I'm also concerned with, is the more we continue to politicize, and the degradation of dollar dependence is about choices we make politically as a country. The boundaries of central banker independence, something, again, I think you understand intimately, are being called into question. How many times does the United States have to play a game of economic chicken with the debt ceiling? And then the types of choices we make on sanctions and the types of countries and entities that are on the receiving end of the long arm of US accountability. All of those trends conspiring at exactly the same time with a global backdrop of deglobalization and fragmentation and sort of economic interdependence, but still begrudging as it may be. I think all of those trends then conspire with a technological wave that enable payment alternatives, utility value alternatives. And so the reserve currency status might be held because of all of those other privileges of the depth of our capital markets and so on. But even there, I still think there's a real trend. And over decades, we've gone from 60% of world trade, or very high 80s, and that trend line continues to wane. And so do we end up in a bipolar environment with potential export currencies like the yuan? The Eurozone certainly is aspiring. And what time horizon does that represent before it really becomes consequential to the United States?
So let's put your U.S. policymaker hat on. You're a U.S. policymaker. What should the U.S. do to enhance the dollar's competitiveness? What are they doing that they shouldn't be doing? What are they not doing that they should be doing? Right.
Well, so speaking to a central banker, in many cases, no choice at all is itself a choice. And in central banking, oftentimes doing nothing is the best thing that you can do. But we have not resisted the temptation to leave Adam Smith's invisible hands unseen. And I think there's this intervention in banking and payments and how we execute sanctions that on the one hand is the attritional risk we're partly discussing in terms of dollar dependency and the utility value of the dollar. The other piece that we're also choosing to do very deliberately through our inability to lead as a country and come up with political compromises and consensus is to enable a domestic financial services innovation environment that, number one, destigmatizes the use of technology in banking and payments. For a country with such a sclerotic, siloed, walled garden domestic payment systems environment, I'm ashamed that it's taken nearly 5 years of public testimony, the president's working group on financial markets, and so many hearings in between to get us to a very basic domestic realization that FedNow should be embraced, that payment systems innovations should be embraced, and that on the edges of how you move dollars around the world, the very best we have produced in 80 years is a monopoly or a duopoly in dollar movement networks. Shame on us. That's a known goal. That goal doesn't require invisible hands. It actually requires action, policy action, political action, and responsible innovation to be regulated and promoted here in the United States. That's an export product. And my analogy is, for example, in the digital currency conversation, there's two choices to be made. Either a digital currency is a public sector innovation and a public good, which in some ways is like the FAA flying planes and building jet engines, or we enable rules-based competition on the movement of money, encouraging lots and lots of payment systems optionality. Those are two things that we can do. On the one hand, do nothing. And on the other, encourage actors, innovators, investors, and entrepreneurs to continue making the dollar the kind of reserve currency of reference when it comes to the innovation.
Also, we can probably come up with a set of standards that reduce the risk for innovators to operate. Because right now, if you don't know what the rule set is, it's pretty difficult to, innovate in this space because you never know what's going to happen from the regulatory side.
That's right.
Go ahead.
I was just going to make one tiny adjoinder there, Bill. The irony, as a company licensed in the United States from sea to shining sea, the likelihood that our digital dollar USDC is regulated by other countries first is very high, because at the federal level, we have failed to enable our federal regulators to come up with a regime, and it's still being debated in the people's house. And so, like democracy, it is the best of the worst alternatives, and hopefully we have exhausted every other option, and now we'll do the right thing.
This is definitely one of the themes of the digital finance papers that we've been publishing over the last year or so, that the regulators really need to be more forward-leaning and come up with a set of ground rules, level playing field, so people can understand how they're going to operate. And I think you really want to encourage innovation as opposed to repress innovation by lack of clarity, by creating a lot of legal risk. And I think that's in fact what's actually happened to some degree. So the US dollar presumably is going to become somewhat less important over time. I think just because the role of the US in the global economy is going to shrink over time. What do you think the consequences is? Let's imagine the US continues to not do much and continues to use sanctions aggressively, and US dollar competitiveness sort of declines. What do you think the consequences are for the United States and for other countries?
Yeah, well, I mean, I think for one, we take many of the ways the dollar is the best and most important US export product for granted in the domestic environment, right? On the other hand, its utility value to real people everywhere is its critical force, right? That if you want, the purchasing power advantage, for example, in emerging and developing countries of US dollars is meaningful. The ability of diaspora populations around the world, many more millions every year being consistently displaced by hardship and climate risk and all these other risks, the ability to make that cross-border payment example usable as a driver of poverty alleviation, a driver of financial inclusion, virtually all of that money flow today is largely dollar dominated and dollar denominated. But tomorrow it may not be, because we have failed to really enable an environment in which the utility value, this is where the analogy, if to have access to telephony continued hinging on fixed line infrastructure, billions of people wouldn't have access to telephony. The world post 5G and mobile internet and the innovations that have enabled it is a very, very powerful world, one that has enabled connectivity despite repressive regimes and despite infrastructure hitting a point of diminishing returns. Banking and much of the infrastructure on which the dollar rides hasn't had a systems upgrade in 50 years. And that's the thing that matters most, I think, over time, is to the technical reserve status might be, a pretty dominant position to decouple, but the network effects that drive the dollar is the space where I think the real competition of the future of money will be held. And therein, we're really just watching, emerging technologies and alternatives develop that over time can develop network effects sufficient to blunt the dollar.
It sounds to me like you think that there's a chance that the dollar could be fine, and all of a sudden not fine fairly quickly if there were these strong network effects in the payment space. So we might notice that something's wrong too late. That seems to be.
That's precisely right. And it's sort of, if you think about the emergence of any technology, and there's all these wonderful charts out there that chronicle the time from introduction to adoption at a certain scale of a population. The most pronounced example, of course, is something like ChatGPT, which is, by any measure, maybe the fastest population adopted technology on record. I think many of the things that are occurring, for example, that are easy to ignore as a hype cycle in the digital currency arena, analogize very closely to the way messaging apps proliferated, like WhatsApp and so on. And that once you start to get to a population sort of scale adoption of a wallet standard, for example, a digital wallet standard, it's very hard to decouple people from that standard. As I had mentioned before, the ECNY went from 0 to more than 300 million total enabled wallets. Whether there's any real flywheel or network effect is a different discussion, but the wallet enablement is a choice being made by retail consumers, businesses, and others. That is a network effect that's very hard to recreate. And those become the rails of the future. It's completely networked, individual point-to-point, peer-to-peer payment alternatives, not conforming necessarily with institutional counterparties in banking and payments. And certainly over time, that's the risk of not conforming to sanctions, values alignment, and so on. And the dollar does need a digital representation at that type of scale to remain competitive.
That's a very good summary, Dante. Zach, why don't we open up for questions now?
Perfect. As a quick reminder, just if you have a question, please type it in that Q&A box. And we have a couple to start with. It looks like William has two. So William, I will go ahead and give you the floor.
Thank you, and excellent presentation. I have two related questions generally about financial statecraft. You hear scenarios about the US dollar being supplanted as a reserve currency anywhere from 10 to 20 to heard as much as 77 years from now. So I was just, I know, given that broad spectrum, I was just curious, and given, and I'll segue with financial statecraft, given all that's going on, Dante, I think you said that it's more of a journey than a destination. In light of the EU's announcement that they were going to, I think, confiscate frozen assets, if the U.S. was to do that, the U.S. Central Bank, Federal Reserve was to do that, in terms of undermining the rule of law, would that be a kind of a tectonic, shift in terms of reserve currency status? I'm thinking also and along the lines of a China-Taiwan invasion. If you either freeze assets or if the Fed was to lower interest rates to keep markets liquid in the event of a geopolitical situation like that, you're essentially helping the Chinese with increasing the capital appreciation on their bond holdings, and then would you then freeze it or confiscate it? So I was just curious, your collective thoughts on that.
I'm happy to start. I think freezing it is very different than confiscating it. There's been plenty of times where bad actors have had their assets in the U.S. frozen. Iran is a good example of it. But in that case of Iran, the money was ultimately, there was a negotiated solution, and the money was ultimately returned to Iran. And I think that's sort of the established benchmark. I think if you're absolutely right, if we start to confiscate assets, that introduces a whole nother risk element. But as I said at the beginning, it really depends on where you sit relative to the U.S. in terms of whether you think you're a friend, neutral, or a potential opponent, because the chances of being hit with confiscation are going to be very small if you're a friend. They're going to be a little bit higher if you're sort of neutral. and they're going to be higher still if you're an enemy of the United States. Dante?
Yeah, no, look, when you described that, it almost reminded me of the Matrix movie, the scene in the Matrix movie where the agent says, "You hear that, Neo? That is the sound of inevitability," and there's an oncoming train coming on the tracks. And so, to Bill's point, part of the conversation really hinges on perspective. But I think the piece that has changed, is a time of conflict, a time of war, and a time where the United States, not only have we thrown every arrow we have in our sort of economic sanctions quiver, we've used every single one of them. And time will tell whether or not to any really particularly good result when it comes to Russia. But we've used all the arrows we have in that quiver, and we've used in some respects many, if not all, of the arrows we have in the combating inflation, domestic payments, domestic sort of finance quiver. And then the question is, what next? And so in that environment, there should be real concerns about economic blocks forming. There should be real concerns. We haven't once discussed the point of bartering, and that in many cases, these currency alternatives and these economic alternatives being arrayed with China and Russia and other countries. In some cases, it's not just about alternative currencies, it's about trading infrastructure for commodities and so on and so forth. And so there's many ways the world can come up with economic alternatives and arrangements. And we no longer have 80 years of history on our side. We have to really start encouraging engagement, encouraging innovation, as I've tried to make the case in today's conversation, to ensure that the dollar can be represented in all of the possible form factors for the 21st century, and not just in reserve currency and government obligation money.
That's the question about how long this transition could take. I mean, I think that's really very much in the U.S. hands. I mean, there's a tremendous amount of inertia in the process. People like to use what they use. And as Dante pointed out, there's very strong network effects. If everyone else is using a given medium of exchange, then that incents you to use that same medium of exchange. So I think it's very much in the U.S. hands. If the U.S. follows intelligent policies, then the dollar should be ascended as a reserve currency, indefinitely. But if the U.S. makes bad choices, as Dante's pointed out, then the demise could come sooner. And if the choices are truly bad, they could be accelerated by the fact that the U.S. payments rails are sort of dramatically inferior to what may be developed in other countries and regions.
Exactly.
All right, thank you very much, William. We'll go next to Paul and then to Barbara.
Hi, Paul Sheard here. Thanks, Bill and Dante. SWIFT got a lot of attention in the context of the sanctions and this discussion. It's a kind of somewhat odd organization describing itself as a cooperative society under Belgian law, and it's owned and operated or controlled in a strictly neutral fashion by its shareholders. So there are some sort of interesting governance issues around the way SWIFT operates. There are also kind of, these technology and innovation issues. It's a messaging system. It looks very clunky. I wonder, Dante or Bill, if you could talk a little bit about what you see as the future of SWIFT. Where does it fit into the ecosystem in the future?
I'm going to defer to Dante on that one. I think you know more about SWIFT than I do.
Well, no, it is an important question, and kind of gets to this past as prologue comment that I made earlier, which is that many of the dominant payment networks, whether they're wholesale, retail, or so on, end up becoming consortia. But the real point is that most of the world's payments innovations, literally from the ages of cuneiform writing and tablets and double entry bookkeeping, all the way until today, are marginal improvements in settlement instructions to counterparties. Right. And so effectively, the SWIFTs of the world and the ACHs and these types of payment networks of the world end up getting to a point of scale, but their utility value is enabling counterparties to provide debit and credit instructions to one another. The reason digital currencies at scale become genuine payment breakthroughs is because you're transmitting the digital bearer instrument to a counterparty, and settlement finality is achieved once that transmission has occurred. There's a reason every central bank and all of the major payments companies were rattled by the advent of the Facebook Libra project. It's because at scale, it would represent a complete competitive breakthrough of some of these dominant networks. And so you're correct in saying that, SWIFT, particularly in its role in exercising Russian sanctions, was the degree to which SWIFT was responsive to sanctions obligations was the only difference in the efficacy of non-military sanctions against Russia. Had SWIFT not taken the call, for example, SWIFT ignored Europe or SWIFT ignored the United States and OFAC, then what efficacy would the weaponization of a currency actually have? You weaponize the rails, not the money itself. And so there are alternatives coming online, alternatives coming into scale, coming into sort of the line of sight. But that's part of what's driving a lot of these payment systems alternatives around the world.
Thank you.
All right. Thank you very much, Paul. And Barbara, we will come to you.
Thank you. And thank you, Dante and Bill, for another really excellent discussion, deep and rich on multiple levels. I think it's important, and Dante started this at the beginning, and I think it merits additional unpacking. It's very important analytically to distinguish between the value proposition associated with the technology and the pushback, the resistance to the dollar as a reserve currency. When I was in government, both in the House and as first Treasury attaché, long before any of this technology was available, it was very clear that the policymakers in Europe, our friends in Europe, did not enjoy what was then kind of the initial beginnings of the weaponization of the financial system. So, and it didn't start there. If you think about it, General de Gaulle is the gentleman who coined the term exorbitant privilege, referring specifically to the reserve currency being the dollar. I think one area where we could do some reflection and perhaps provide perspective is, people love to hate whoever's at the top of the pyramid. They love to hate that. And the dialogue disturbs me in a way from that side, because the impression is, and they'd like to give the impression that somehow people were forced to use the dollar. I think Dante's arguments are the most powerful because when you talk about giving people choice is what America's been about forever, and it's what we will, I hope, always be about, unlike other sovereigns that shall remain unnamed, big ones. The point being, for so long as the Fed makes itself an easy target by resisting the technology, by resisting the capacity for people to make choices, the more they strengthen the value proposition on the other side. And that is tremendously problematic. We should want people to still use the dollar. And by the way, my last observation, while there are tremendous benefits, there are also tremendous obligations that come with serving as a reserve currency. And for anyone who hasn't read the FOMC transcripts from the autumn of 2008, I strongly recommend them. But the first time I read them, I had a bit of PTSD. But the reason why I say it is that when push came to shove, the Federal Reserve did the right thing for the dollar, did the right thing for the United States. They don't get enough credit for that. At a point in time when it really mattered, and they paid a stiff political price for it. And I think a lot of people don't even realize that the Fed has been a good steward of the dollar globally. These are things that just don't make it into the discussion. I'm not sure what the right vehicle is, but I think someone needs to start reminding people that the United States actually does do the right thing. Hopefully not always when all other with due respect both to Dante and Winston Churchill, hopefully we don't have to exhaust all the other options first. So this is one of the reasons why I love being part of the Bretton Woods Committee. You give me things to think about. So I don't really have a question, but I really have enjoyed this conversation, and I hope we do more of the kind of thinking that really push the ball forward.
There's not a question there, but let me just sort of give you my perspective on the Federal Reserve in all of this. In 2008, basically, we wanted to provide dollar liquidity around the world, because if we didn't, we thought that there'd be wholesale liquidation of dollar assets that would depress dollar prices, prices of those assets, and that would just exacerbate the pressure on major financial institutions around the world. So, end of the day, we did it because it was in the U.S.'s interest. It was in the interest of the global financial system. But as you noted, it was actually controversial, and I actually had to go testify before Congress with Mark Zobel, who's another member of the Bretton Woods Committee, to basically justify why these foreign exchange swap arrangements were a good thing rather than a bad thing. Now, I think the good news is it seems like these foreign exchange swap agreements, where the Federal Reserve essentially commits to providing dollar liquidity around the world in times of stress, seem to be less controversial today than they were 14, 15 years ago. Because I noticed that when Credit Suisse got into difficulty, we changed the frequency of the weekly auctions of dollar liquidity from weekly to daily, and nobody had a problem with that at all. So I think the U.S. use of looking at the U.S. role as a lender of last resort, I think people now understand that role doesn't really just stop at the U.S. borders, that there's also an important role to support the dollar as a viable currency. But you're absolutely right. That's not necessarily baked in the cake forever. And if the political process in the U.S. were to move to a much more isolationist perspective, that tool for the Fed could potentially be lost. But right now it looks like it's in pretty good shape. I don't see anyone being really alarmed about the Federal Reserve's foreign exchange swap network.
Fair, very fair. And then with a stable coin, in a stable coin situation where many of the stable coins are also held abroad, the Fed can also acquire significant information from on-chain analytics that could be useful to managing a crisis.
Well, the one quick add-on I would make, and Barbara, always great to hear your voice and your comments. The one quick add-on I would make is, if in fact we are in a digital currency space race or a digital currency 5G wars, the way the United States won the real space race was political leadership establishing a whole of society destination. And there's a lot of things we take for granted since. Imagine stopping the development of the internet at the worldwide wait phase, right? And so I do think that's the piece that I'm most begrudging as sort of an entrepreneur or an innovator in this market, is that we've just effectively resigned ourselves to the only way the dollar will ever move is in the ways that it has moved for the last 80 years. There's nothing good that comes of the next decade if that's the trend line societally we're making a choice for. And we've already effectively made that choice by not making a choice at all.
I agree with you about that.
No, I agree with Dante. I mean, I think part of the problem is that for the central bank, just from my perspective, is two things. Number one, it's always hard to make decisions when you don't know the full consequences of that decision. So the Federal Reserve is sort of nervous about, well, if I go down if I make a particular active choice, that choice could turn out to be bad, because it's not really knowable exactly how all these things are going to evolve over time. We don't really know how the technology is going to evolve. We don't know exactly how it's going to be used. We don't know what sort of business models are going to be created. And so there's a little bit of, I would say, risk aversion on the part of the Federal Reserve. And I think, as Dante said, though, not making a choice is making a choice over the medium to longer term. The second thing is, I think, one of the challenges for central banks around the world is lack of deep technological expertise. If you look at the technology that the Fed uses, it's not cutting edge technology. It's just not cutting edge technology. And the policymakers that make the decisions in the Fed are typically not technologists. So, the central bank is sort of, not very well placed. And yeah, they probably aren't competitive in terms of pay, in terms of bringing technologists in to help the central bank. Let me ask a question for Dante. I mean, if you were trying to get the Fed to move, what could the private sector do to help the Fed get more comfortable with all of these things?
Well, so as a matter of fact, I feel like I've done a lot by by putting my name next to the Libra project, right? Pre-Libra, not a single central bank anywhere in the world was talking about a digital currency competition, whether wholesale or retail. The simplest things the Fed could do was, number one, destigmatize the provisioning of central bank services to non-bank entities. It's a space in which we're an outlier. Again, every major economy, every major payment zone in the world has access to banks and non-banks to central bank services. If you want FedNow to work, and as a taxpayer, I really do want FedNow to work, then non-banks need to be permissioned in and provisioned into the system. Because guess what? The walled garden problem in payments is horrible, right? The analogy we use in the payments world is, how usable would your email be if Hotmail couldn't send an email to Gmail and Yahoo and so on? And so that technological risk and the lack of interoperability of payment rails is a perennial, persistent problem. And over time, it ends up becoming a societal vulnerability, as we saw with COVID-19 payments and as we see around the world in terms of payments alternatives. So the simplest thing for the Fed to do, especially if we want our central bank to keep its mandate of dealing with the macroeconomy and keep its invisible hands, is to create rules-based competition for payments and financial markets infrastructure innovations for both banks and non-banks. The banker doth protest too much when it comes to a lot of the innovations that we're talking about. And it begs the question, why? Because banks love non-interest sources of income. And then there's this convenience factor. If you want a fast payment executed in banking, remember back in the day when fixed line telephone calls, you paid for the distance traveled on the fixed line. In banking, if you want a fast payment, you pay for speed. But yet these things are commodity-free services. The more and more we think of, open payment networks and open payment alternatives. So that's the simplest thing for the Fed to do. The worst thing for the Fed to do is to try to out-China China and come up with a central bank mandated retail payments alternative that is foisted upon the American people and therefore the world. We would lose any dominance that we have. We would end up killing retail competition, which is the space in which past is prologue yet again in terms of banking, payments, and finance.
Great. I have one question that a member of the audience asked me to read out. Large institutions hold US dollars and US treasuries. There are currently several platforms working on on-chain, short duration US treasury funds that enable holders of US treasuries to hold the funds via a traditional custodian bank as well as in DeFi on-chain. Is this likely to get sign-off from the SEC? Is this likely to be adopted faster by institutional investors than stablecoin funds?
Yeah, I'm going to take it. Bill wants me to at least take a crack at that question. So, look, I could probably have a better luck looking into my crystal ball and predicting the 10 to 30 year trajectory of dollarization around the world than I can to peer into the mind of what gets cleared by the SEC in this particular environment. And so nothing I say is investment advice. What I would say, however, is this wave of multi-trillion-dollar institutional interest in not only digital currencies, but in utility value-based innovations and how money moves is a very real wave. Economic competitiveness for a country will be determined by how we harness time, talent, and treasure. And that sign of institutional interest, whether it's BlackRock filing a Bitcoin ETF or other major institutional investors trying to get into the digital assets ecosystem, they're not doing it for altruism or charity. They're doing it to remain competitive and relevant in the 21st century. And so if you think about it, our financial needs don't take bank holidays. They're literally always on. But the banking, payments, and capital markets that we're all discussing take breaks. And you could argue maybe those breaks are usable to reset the system and to avoid burnout. But again, they're just not keeping up with the times. And so that institutional interest is very real. And as a country, we should welcome, in the category of, imitation is the sincerest form of flattery, that people are trying to denominate the totality of digital assets in dollars. We should take that as a sign of flattery and enable it. That's the piece that we're not doing today. We're not enabling it at the federal level. And today it lives under the states, under a patchwork mosaic of state regulation and oversight. But that's the gap the United States faces from a competitiveness vantage point.
Just to add, one of the other issues that we really haven't talked about is, but we've sort of touched on it in an ancillary way is, in the U.S. there's a very long tradition of banking and commerce not mixing. So we don't want Walmart to have a bank. We don't want Amazon to have a bank. And the fear of mixing commerce and banking is the fact that if you mix it together, then how do you avoid self-dealing, where the bank is sort of essentially used to fund the commercial entity? And that I think is a very particular problem to the United States, and something that the Federal Reserve needs to sort out, because end of the day, you do want non-bank financial intermediaries to have access to the payment space, but you also want to have protections in place that they're not using that access for inappropriate purposes.
Great. I think we can end our Q&A there. Bill, I'll give it to you for the last word in just a minute, but I did want to take the opportunity to thank you both very much for joining us today. It's been a great conversation, and thank you to everyone for watching. Bill, anything to add at the end?
Well, this is Dante is a featured speaker here, so I'm going to turn it to Dante for any final thoughts.
No, thank you so much, Bill, and thank you, of course, to the Bretton Woods Committee and to the wonderful questions and engagement from guests. I think the only thing I could appeal to is we should not assume that we, as a country, have natural advantages that don't require innovations on the edges. And the thing that I hoped to really convey today was there's an opportunity. We already have a leadership position as a country. Much of the world really depends on that leadership position and U.S. steady hands, but the dollar's role as a reserve currency is not just the degrees to which institutions trust it and hold it, it's the degrees to which it can move in the 21st century. And that's the space where I think we have the most risk, but we also have the most opportunity if we harness it. And so hopefully today's conversation was insightful.
Fantastic. Thank you both very much.
Thank you.
Thank you.